Hey, what's going on, everybody? It's Steve from the Zahnd Team coming at you with another market update. It is December 15th, and I got the latest data for you about the real estate market and also what's going on in the world economic view. All right, so let's begin with what's going on in the world economic view and how that could relate to your real estate market information. All right, so to kick it off, I got some notes in front of me right here, so let me just dive into them. Well, the first big news that came out from the US is that inflation was a beat in the US CPI report. So they were expecting 7.1% and it came in at, they were expecting 7.4% and it came in at 7.1%. That was a beat. Markets rallied, even though it was short lived. So after the markets rallied a little bit, the Fed chair said that Jerome Powell mentioned that they don't see any future forecasts where interest rates are going to slow down in the future. They want to see more meaningful decline in inflation before they even think about pausing rates. So that sent markets to retreat from their previous rally from the good news. However, that being said, though, that could be an indicator for Canadian inflation, which is coming up on the 21st of December. So our readings are coming on the 21st of December. And what we got in Canada is we're looking at expectations coming in at 6.7%. So if you remember from the last reading that took place, we were sitting at 6.9%. So that'd be a 0.2% decrease. So that's what the expectations are coming in. But with the US being a beat, it could set up Canada for a beat as well, which would potentially rally bond yields to fall even further, which will impact your real estate purchasing power. All right. So what I want to kind of get into here is that it looks like some of this good news about inflation coming down is setting off a decline in bond yields, which will tie into the 5-year fixed mortgage. So that's some really good news if you're looking at locking in at a 5-year fixed rate. So what else happened in Canada? Well, as you may know, on December 7th, the Bank of Canada raised interest rates by another 50 basis points, 0.5%, which sent the key lending rate to 4.25%. So some comments suggest that the future decisions are not set in stone. So they actually didn't say they were guaranteed to raise rates in the future, and that they may keep things stable based on the economic data that's going to come in. So, we could see no increase in the next meeting, or we could see a 25 basis points increase or 50 basis points, depending on the economic data that comes out. However, what we are seeing though is that the bond yields have dropped to some of the lowest levels in recent time, and that's an indicator that the market is seeing that that the federal government, the Bank of Canada, is likely not going to be more aggressive in monetary tightening. So a lot of what the bond market is showing us is that people believe and people are speculating that the tightening is over and that we should see some more rallying or potentially easing of tightening. So that's sending bond rates down, which will have a direct impact on 5-year fixed rates. Let me see what else I got to cover here for you. Yeah, so the variable rate mortgage, as you probably know, has increased. We'll get into interest rates a little bit later. And that's pretty much all you need to know about that. And now I'll get into the mortgage rates and how that's all affected here. So let me just switch over to my screen so you can see what's going on. All right, we are in screen share mode. Okay, so here we go. I wanted to first kick off with interest rates and show you that because of the bond yields coming down, we're seeing interest rates. The 5-year fix has now being less than 5%. So these rates are brought to you by Frank Mortgages. They're a great mortgage partner of ours. They provide us great economic insights as well as some of the best rates you can find anywhere. So definitely check out Frank Mortgages. We'll have the link in the video below. So check that out. So what I wanted to show you here is essentially the correlation between bond yields and the 5-year fixed rate. So as you can see here, back in August, our fixed rate was about 4.25% and bond yields were about 2.61%. There's a 1.64% spread between the 5-year fixed and the 5-year bond yield. So as you saw, when the bond yield spread, when the spread between the 5-year fixed and the bond yield is low, close to 1%, you usually see in the next subsequent reading that I provide that interest rates spike up. So here's an example. It got down to 1%. Mortgage rates jumped up to 4.59. Here again, the spread shrunk again to 1%. And now that pushed up the 5-year fix to 4.84. However, now on the flip side, with some positive economic data coming out, we're seeing that spread increase closer to 2%. And when they get to the 2% range, it looks like that's their threshold to start dropping rates. So Here in November 15th reading, we had a 1.7% spread between the 5-year fixed and the 5-year bond yield, and that triggered an interest lowering to 4.84. But what happened? Bond yields kept falling, which then showed that we had another, that at the end of that month, we had a spread of 1.83, and that triggered now another rate drop. But what's going on here again? Well, as you can see, bond yields are even lower again, which means there's still a healthy spread, which could breed some competition in the 5-year fixed. And who knows, it looks like probably by the January 1st reading, we could have even lower 5-year fixed mortgage rates. So what's that going to do to the real estate industry? Well, it could mean that some people will potentially jump into the market now that they see that there's some stabilization in the marketplace. They see inflation is starting to trend down. It is now becoming a trend where it's peaked out in August, and every single month thereafter it hasn't gone up. And it looks like bond yields and the markets are expecting that the tightening is over and that potentially things are now achieving stability. Inflation is coming down, which then can lead the bond yields to go down, which leads the mortgage rates to also go down, which will provide purchasers, buyers of real estate, a lower monthly payment, as well as a lower monthly payment and a little bit more purchasing power as well. And I'm going to get into another video eventually about why now is the right time to potentially upgrade your home and show you the savings that you can have by doing that. But I just wanted to show you that. So the first part of the video was about the macroeconomic factors here. The second part of the video is just about the interest rates and how that's affected and how that the 5-year bond yield affects the interest rates and what that means for you as a consumer. All right, so now with all that fun stuff said and done, let's take a look at the actual market and see what's happening. So as we can see here, we have approximately 169 units on the market right now, and our 5-year average is typically around 155. That means we're sitting about a 9% increase of our inventory where we're usually at. So we have some healthy inventory. It's not sky high. It's not 40, 50% more than what the typical rate is. It's right at our 5-year averages, and considering the amount of buying that has not happened, purchasing it has dropped 25 to 40%, and essentially, with that much decrease in buying, you'd expect inventories to be much higher. So we're still at our 5-year averages, as you can see represented right in this graph right here. And you can see the asset class is very stable. There's nothing really out of whack. Everything is pretty common to its 5-year fixed area, except for condos have a little bit of excess inventory in it right now. Okay, so what about what's going on with the supply side? Interestingly enough, we're seeing about 3.5 homes come to the market every single day. So what does that mean? Well, the average we usually get in December is around 2.5 homes a day. So that means we have about a 40% increase of homes coming into the market than we typically do. As you can see here, we have about 78 homes that usually come to the market in December, and we're already at 53. But let's just make sure we're clear about this. Probably in the last 2 weeks of December, when we're around the holidays, you can expect a lot less homes coming to the market. So you really do believe that December is pretty much front loaded and a lot of stuff isn't coming in on the back end. So it's going to be interesting to see where we end in December. I personally believe we're going to be right in line with that 5-year average by the end of the month. Okay, going to the outflow side. So this is how many homes are being sold, not expired, just sold. We have 44 homes that so far sold in the month of December. So that's tracking at about 2.9 homes a day. And what we usually do is about 3.5 homes a day based on our 5-year averages. So the consumption, even though it's down to 15% lower than it usually is, it's almost 100% better than it was last month. So in last month, we had almost a 40% decline in sales, and now that's chopped in less than half. So it looks like purchasing has actually increased, even though the numbers are a little bit down. But seasonality-wise, it looks like things are starting to trend the other way. And I have some super interesting real estate market data to show you that's showing that the real estate market is definitely stabilizing. And with the stabilization in the real estate market, plus now the lowering of the 5-year fixed interest rate, you could see that January, February, March, Q1 could see some healthy buying, so long as that the CPI inflationary data is coming in at expectations or lower, and that the bond yields continue tracking down with this good news, which will then continue putting pressure on that 5-year fixed rate. Okay, so let's take a look at homes that failed to sell. It's just the theme of 2022, I guess. Failed homes are at 2.7 homes a day, which is quite considerably up from our average of 1.4 homes. So there's almost 100% increase in failed home sales. That is not the highest. The highest was when we were back in May and April, where 127 and 118% extra homes failed to sell. Still in a really high number. So let's keep looking at some indicators. And this is where I'm seeing that the market is starting to show signs of turning around from not to a dovish stance. It's not a bearish stance anymore. It's like we're not seeing that knife falling through the floor anymore. But we're also not seeing a spike. So it's not either or. It just seems a little bit neutral. It's a bit flat. And there's some indicators now showing that the market is recovering. As you can see, days on market. So for example, going down from 8 all the way up to almost 30 days on market here, but now the trend is starting to reverse and go back down. So we're at 24 days on market in December, which is a positive sign. What's another positive sign? Well, looking at the quarterly, we're pretty flat. So from Q3 to Q4, there's only a 2-day increase versus, as you see in Q2 to Q3, we had a 13-day increase. So that's 100% increase from Q2 to Q3. And here from Q3 to Q4, we only had an 11% increase. So only a 2, it must be a fraction here that I got. Let me see, it's a 2.8 day increase. So much more stable, slowing down. The bearish tones are definitely lessening here. How about the list price to sale price ratio? Here again, as you can see, from 112 to 120 at the peak of the market, our list price to sale price ratio was going down, down, down until we hit August, which was one of the highest inflationary months that we had in Canada, and that correlated to one of the lowest list price to sale price ratio, interestingly enough, and that came at 93.6% in August. Since August, though, list price to sale price ratio has been creeping up very steadily. So 95 in September, October, November, and then here we inched up a little bit higher from 96.1 to 96.6. Another indicator that the market looks to be turning. How about the quarterly list price to sale price ratio? Another indication that it's going up there. So you can see that here as well, represented by the red and green. How about the monthly average sale price? So there's some really interesting data here that I want to go over with you. And we can see here that December so far, I know it's only 44 sales. That's why I like looking at the quarterly data as well. But as you can see here, with December, the average sale price is coming in at $733,000, which is just 0.41% lower than it was in November when it came in at $736,000. So I had some comments on the videos that said, hey, Steve, why do you believe the market's stabilizing? It's still falling. Absolutely, the market did drop 0.41%. Dropped 1.55% the month previous and 4.8% the month before that. So how is this stabilizing? Well, I'll show you what I mean by stabilization. So from the peak right here, from the peak of the market, which was in April, to August, and the reason I selected August is because it correlates to August 2017, which I was comparing 2022 to 2017 a lot. So I was just kind of saying, okay, well, where was the biggest fall? And April to August in 2017, I would just want to measure that gap. And it looked like from April to August here in 2022, the market dropped 24%. Since then, the peak to December, so April to December, it dropped 27%. So as you can see, in the short time frame of April to August, we did almost, what is that, about 89% of the drop happened in those few months. Sorry about that. Happened in those few months. And then since October, the market has corrected 2% down. So that's a lot better than dropping 27%, 24% all at once, right? So essentially you're going from a straight knife down, 24% drop down, to now a 2% decline. And as you can see here, it's represented right in the graph. Sharp fall, a little bit of stabilization, a little bit of drop, and now you got a lot of stabilization right here. So it does look like that the market has now stabilized, and we're looking pretty good here. Next on the quarterly review, just jumping into the quarterly review here. The fourth quarter is sitting around 741,000, and now this is the first quarter that we're seeing that home prices are now upside down. Obviously on the month-over-month chart, it was upside down a little bit sooner, However, there's less data in a month than there is in a quarter. So looking at the quarterly just gives you a little more of a nice data set to see what's actually happening in the marketplace. So if you bought in the first quarter, you were up 31% year over year. Second quarter, you're up 21%. Q3, as long as you bought in Q3, and if you're selling now, you're still 2.3% higher, 2.3% higher than you were in last year. And now, for the first time, we're actually underwater here for the first time here at 10.71%, going year over year. So yeah, we are upside down now. However, I do want to show you that if you did buy in 2018, you are still up almost 50% from what you would have bought at in 2018. If you bought in 2019, you're still up 35%. And if you're up 2020, if you bought in 2020, you're still up almost 15%. So it's just if you bought in the last year that you're now seeing yourself a little bit upside down. However, you bought before that, you haven't lost anything. You still gained. You still have the home that you want, and you still gained in the marketplace, which is good to know. So I just wanted to give you that piece of encouragement and optimism that, yeah, just as long as you didn't buy exactly in Q4 last year, you're still good. Okay, so now to put it all in a bow and bring it all together for you, let's take a look at the the whole inventory flow report. So this is 2022 in a nutshell. And for the very first time, actually, I want to show you something interesting. Let's go to Outflow sold. As you can see, typically in a year, we sell around 2,400 homes a year in the city of Guelph. And it looks like for the very first time, as you can see at all this data over here, it looks like for the very first time, we're not even going to break 2,000 homes. So there is a considerable drop, as you can see with all this red over here. That outflow has really taken a hit, and obviously you can see that with that hit, we saw the average sale price decline quite significantly from the top. Okay, going to the outflow report here, kind of showing you from a high level. So the green line represents everything coming into the market, and the red line represents everything going out of the market. The red line takes into consideration sold properties as well as failed to sell properties. So in the year of 2022, we brought in almost 2,300 homes, which is almost 7% more than we typically do in a year. So we didn't get a crazy amount more inventory. The inventory stayed the supply coming into the market was pretty steady and very typical year over year, 6% higher, nothing crazy. Sold, however, though, versus our 5-year average, we sold almost 419 homes less than we usually do, which represents almost an 18% drop in homes sold. And then if we look at last year, which as we all know, which was a crazy market, 740 homes less sold, which is down almost 28%. Total failed to sales. Now this one is a wild stat here. Almost 1,188 homes failed to sell, which was 155% more than what happened last year and 64% more than our 5-year average. So a lot of homes failed to sell this year, and that's why our total inventory gained is only at 154 units. This is great though, because over the last few years, inventory was absolutely decimated, and that shortage of inventory when more money is chasing fewer goods, right? There was a lot of stimulus last year, a lot of money being printed, and that created a lot more money chasing fewer goods because obviously last year there was no inventory on the market. So with low interest rates, lots of money, and no inventory, that really caused this real estate bubble to really blow up a little bit back in February and April when we saw the peak. And now we're seeing the air coming out of that balloon pretty rapidly over the last few months here and now stabilizing. But it's still really great to see 154 units. One thing that I do want to mention here, if you are a buyer looking into the market here, this is a really important note for you if you are a buyer. If you're a buyer looking to buy next year, I would have expected that the real estate inventory level to be at least another 100 units higher than we are right now. If you're getting 50% less sales month over month over month over month, that inventory technically should be stacking up. However, the inventory didn't stack up. We're right around our 5-year averages. So what this tells me is if there's any kind of easing in monetary policy, if the demand in home purchasing picks up just a little bit, we're going to see home prices go up pretty rapidly because There's one thing that hasn't been fixed yet. So in a lot of other areas in the world and the economy, supply chains are getting fixed. There's more inventory being produced than being consumed. That's what driving up inventories, which is then driving prices down. In real estate, however, that inventory is not flooding the market. The supply side of real estate has not been fixed. So when new demand is introduced into the marketplace, the existing inventory is going to be snatched up at a rapid pace because there's just not enough to go around. So this is kind of like what I'm indicating, and I'm putting my opinion out there that if I do see increase in a decrease in interest rates and a tick up in purchasing, inventory is going to vanish, and there's fewer options, and then people are going to start competing again. So if you're trying to avoid competition, you want to take advantage of the lower interest rates that are coming into the marketplace right now. I really do believe that January and February could be really good buying opportunities before a lot of the rush comes in. And I'll show you how you're actually going to be paying less on a monthly basis using today's interest rates than using February's interest rates that were rock bottom, but the average sale price was sky high. So yes, rates are higher right now than they were in February, but the average sale price has dropped enough that your monthly payment is lower. And I'll show you that in a separate video. Okay, so that what's going to happen here is that right now there's 169 units left on the market after we see the inflow, outflow, failed sales, total inventory on the market right now, 169 units. There's an average flow out of the market at 3.5 homes a day, and what's flowing into the market's 3.5 homes a day. Flowing out, it's about 2.9. So we're gonna have about 274 homes to consume, and then when it's all said and done, there should be about 187 homes remaining. Okay, so if there's 187 homes remaining in 30 days, if 2.9 homes a day sell and no new inventory comes to the market, that means 1.5 months of inventory is what we have. So in 1.5 months, all the houses will be gone. So typically in a really hot seller's market like we saw last year, we saw that the months of inventory was below 1 and actually close to 0 is about 0.2, 0.3 months of inventory. And we actually spiked up to about 2.5 months of inventory at one point when we're kind of back here in August. We're right back down to 1.5, which is a pretty balanced market. So that is essentially the market update in a nutshell. If you have any questions, please feel free to reach out to us. We'll have a link to the page here if you're interested in booking a strategy call about buying, selling, anything that you need in real estate. Click that link, book a call with the team, and we'll take care of you. Thanks for everything. We'll talk to you soon.